Hi, my name is Chantal Grayson and welcome to the Real Hub TV. I'm a licensed real estate and mortgage professional in the state of California, and in today's episode we're going to be talking about the 4 C's of mortgage finance, which are capital, collateral, capacity, and credit. So let's get right into it because this is really important. It helps the lender know whether you're ready to buy a home, whether you're going to have the ability to pay back the home loan. Of course, there are things that happen, like nobody expected COVID-19 to happen, so sometimes the 4 C's won't stand up. But initially, this is what most lenders look for when you're applying either for your first time home and or a piece of investment property. So let's get right into it. So the first C is capital. Capital is your readily available money. So basically what that means is any savings account that you may have or retirement accounts that you may have that you're able to liquidate. The lender is basically looking that you have anywhere from 1 month to 3 months of reserves. Sometimes a lender may ask for more, but that's generally not the norm. So basically that's what capital is. It's pretty straightforward. How much money you have readily available in order to qualify for a home loan. Number 2, collateral. Collateral is so important. Okay, so a lot of people think that collateral is only the house itself or the piece of property that you're trying to purchase or the piece of property that you're trying to refinance. But actually, collateral can also mean anything of value. So for example, if you had a Van Gogh or if you had a Picasso, you could actually put those items up for a loan. Now, I don't know how many lenders actually, go for that, but it is acceptable that you use something other than the property as collateral. So, number 2, collateral. Anything of value that you can use to put up for the property in exchange for the loan. So, for example, if you don't pay the loan, they will come and collect that Picasso or that Van Gogh or your home. Number 3. Number 3 is capacity. And basically what capacity means is your ability to pay back the loan. So what lenders look for is how much money you're making, whether that be your base salary plus bonuses, any type of stipend that you may get, any secondary job income, any income from alimony or child support are also looked at this particular point. And they also then take into account your expenses, your car expenses, your student loans, which are a whole nother nightmare, but we'll get into that in another video. And then they also take that information, so your housing expenses, anything that your credit card debt, super important. So what the lender will do is they'll take your amount of income, your amount of expenses, they do a formula that's called debt to income ratio, and then they get a percentage. That percentage generally needs to be anywhere from 39% to, I would say, about 45%. Some lenders will go up to 50%, but it's on a case-by-case basis. The safest way is to keep your debt to income ratio as low as possible. Anyway, that is capacity, your ability to repay the loan based on your income and your expenses. And number 4 is credit. A lot of people get credit and capacity mixed up. Why? Because with capacity, they're looking at your credit, which is your expenses, your credit card bills, your car payment, any other rental payments that you may have, child support, alimony, and your income. And then they do this thing called a DTI, which is, like I said, debt to income ratio. Whereas credit is just that. It is a list that's pulled from either TransUnion, Equifax, or Experian, and it basically tells the lender whether or not you pay your bills on time. That's all what a credit report is. Basically, it just says that you have so many revolving credits, so many open credits, so many liens, so many judgments, and yes, you do pay them every single month when they're due. If you don't pay them, so for example, if you miss paying your housing mortgage because you're trying to refinance, well, lenders don't look very favorably upon that. So it's really important that even if you're not applying for a loan, that you try to keep your credit score as high as possible. A good credit range is anywhere from 680 to anywhere in the 7s. If you happen to be in the 8s, that is phenomenal and you're doing a great job. Again, that is the 4 C's of mortgage finance. Hey, my name is Chantal Grayson, and that was the 4 C's of mortgage finance, which are capital, collateral, capacity, and credit. Thank you so much for watching the Real Hub TV. I'm Chantal Grayson, a licensed real estate and mortgage professional in the state of California. If you like what you heard, please don't forget to like, share, and subscribe to the Real Hub TV, where we talk about everything from buying, selling, investment, and of course, mortgage finance. Thank you so much for watching. Goodbye.